Hi, I want to welcome everyone to today's webinar. I'm Ryan Fisher with Camel We have William Bonatti of JKAM Alternative Investments here with us today. Just a quick, disclosure here before we get started. Camel does not give any investment advice, tax or legal advice. We're here to be a tool that you can use to be able to make alternative investments. Or just consider us, a part of your team. Do all of your own due diligence before making any investment. All the information today is provided as educational information. This is my contact information. If you have any questions about, using your retirement account, IRAs, 401ks, 403bs, etc., any qualified funds, I can help answer that for you. My email, rfisher, and that Fisher's with a C, RFISCHER at CAMAPLAN.com. So I'll go ahead and turn this over to William, and he can tell you a little bit about himself. I think he has some great information to share with us today. Welcome, William. Thanks for being here.
Yeah. Hey, thanks, Ryan. And thanks everybody for joining. And thanks to the CAMA team and Ryan for continuing to put together all these programs. I think it's a great resource for your audience. Ryan, if you want to share or let me share my screen, or stop sharing your screen, and then I can share mine. Then I'll just jump into the PowerPoint that I have set up for today. All right, Ryan, can you see that first slide there? Awesome. So the purpose of today's content or webinar is how inflation can be damaging to traditional types of investment products like stocks, bonds, etc., and why real estate is a great hedge against that. So we also have a disclaimer here that just in case you need more disclosures, this is being recorded, so you can pause and read through this if you feel it's necessary at a later time. So jumping in, I'll be doing a brief introduction on myself, sharing the strategy and goal of the JCAM fund, which is success through economic cycles. We'll look at past inflation rates, some of the warning signs that we're seeing, just in case you haven't already personally experienced this in your day-to-day, some common investing strategies to protect against inflation, and why and how real estate is a good hedge against inflation. And then we'll lastly wrap it up with any questions or comments that you guys may have, and then my contact information. So getting to who I am. So for those of you who don't know me, I am William Bonatti. I grew up in Colorado and got a degree in finance and real estate from Colorado State University. Right out of college, I obtained the Series 66 in life and health, and spent about 7 years in banking and investments. And then I transitioned into a more entrepreneurial path through investing in real estate. And that started out by wholesaling houses, then flipping houses, and then investing into non-performing loans. And while I was living in New York City in 2014, I connected with Jack Krupe, and then joined his team to run his NPL dispositions trade desk. I was there for 2 years, and both Jack and I left to pivot and form the JCAM Diversified Real Estate Fund. So right now, my family and I currently live in the Vail Valley, which many of you may know of or visit from time to time. So if you're ever out this way, let me know. I can show you some good skiing lines or snowboarding lines or fishing holes. So the JCAM Diversified Real Estate Fund's goal is to help our investors succeed in economic cycles through tax-advantaged investments with a combination of cash flow and upside. Our fund gives passive investors the opportunity to achieve diversification access to projects that are almost always off market, and participate in the tax advantages of real estate. The fund was born out of the need to solve some of the roadblocks passive investors face, which include the time and knowledge it takes to source, review, and underwrite projects, achieve diversification among operators and projects and geographies, all with a lower minimum. And we do that all in one fund. So that's who I am and who we are. Getting to the topic of today, which is inflation. I'm sure most of you have heard of or experienced inflation, but I think it's a great place to start with the definition. So also important to note that I'm going to be discussing these concepts with broad strokes, and this is not intended to be an exhaustive and detailed account of inflation and monetary policy. That's a whole nother webinar. So keep that in mind. So what is inflation? Inflation is the rate at which the value of currency is falling, and consequently, when the general level of prices for goods and services are rising. So the most commonly used inflation index are the Consumer Price Index, also known as CPI, and the Wholesale Price Index, WPI. Those with tangible or physical assets like property or stocked commodities may like to see some inflation, as that raises the value of their assets. The CPI is a measure that examines the weighted average of prices of a basket of goods and services, which are primary consumer needs. These include transportation, food, and medical care. The prices in consideration are the retail prices of each item as available for purchase by those individual citizens. So changes in the CPI are used in general to assess the associated cost of living, making it one of the most frequently used statistics for identifying periods of inflation or deflation. In the US, the Bureau of Labor Statistics reports the CPI on a monthly basis and has calculated it as far back as 1913. So just touching on the WPI, this is another popular measure of inflation, which measures and tracks the changes in price of goods in the stages before retail level. So investors seeking to protect their portfolios from inflation should consider inflation-hedged assets, such as physical commodities like gold and silver, bullion, and then also real estate. So this chart gives a sense of how dramatically inflation can reduce purchasing power. The negative impact of rising inflation keeps the Fed diligent and focused on detecting early warning signs to anticipate any unexpected rise in inflation. The sudden increase in inflation is generally considered the most painful, as it takes companies several quarters to be able to pass along higher input costs to consumers. And likewise, consumers feel the unexpected pinch when goods and services cost more. However, ultimately, businesses and consumers eventually become acclimated to the new pricing environment. What generally happens is this pushes consumers to hold less cash because of the value over time decreases with inflation. It also pushes investors or consumers into alternative assets that are a hedge against inflation. So fears of inflation in the year ahead just hit its highest level on record. This was reported by the Federal Reserve Bank of New York. When inflation rises, savers should consider alternatives for stashing cash. So many will say the hedge against inflation is gold, silver, oil, copper, commodities, etc. This is mostly true, but if you truly want to hedge against inflation, you need to buy physical gold or silver bullion, not the derivatives. Furthermore, just as you should diversify among the traditional investment assets like stocks and bonds, you should diversify among inflation hedges, and real estate should not be overlooked as an asset class to hedge against inflation. There are clear warning signs of inflation. In May 2021, Consumer Price Index jumped 5% from a year earlier. the fastest pace since just before the 08-09 financial crisis. Some may say, the Fed may say, many may say that it's only temporary, but with the Fed in a tough position and unable to raise interest rates in a meaningful way without crushing the economy, inflation will continue to be an ongoing issue going forward. Here we're looking at a chart showing month-over-month change in CPI and year-over-year. So the CPI was up 0.9% in the month of June and up 5.4% versus this time last year. This may not be news to most of you because you're probably experiencing this in your everyday lives. Here's another indicator that inflation, that consumers really feel. And this is the retail price of used cars jumped 10.5% between May and June 2021, following a 7% jump the month before. So used car prices have risen dramatically because of a shortage of available new cars and a general increase in car demand. This is largely from the decreased supply in fleet sales, repossessions, and off-lease cars entering the used car market, which shrinks the supply. Additionally, there's global supply chain constraints that has impacted new car production. There are a few signs of a rebound, though. Car wholesale prices dropped more than 2% over the last 4 weeks, and prices are expected to stabilize in the fall, but computer chip shortage, again, will play a role in the prices normalizing. So, this is broad strokes, guys. This is truly a supply and demand issue, and only one example of many sectors experiencing inflationary pressure. So looking at these traditional investing options, these are what people generally are aware of. Now, clearly you guys know more than most because you have a self-directed IRA, or you're thinking about a self-directed IRA because of the many benefits. So you're a little further along than most, but for the purpose of this discussion, I'm going to keep it simple. So the traditional options generally are thought of as savings accounts, CDs, stocks, and bonds. And many people believe these to be their only options because that's what their trusted financial advisor or wealth advisor says. These advisors will also most of the time say you need to have a diversified portfolio that matches your risk tolerance. And this is usually only a mix of stocks and bonds. Sometimes, though, they will recommend commodities or real estate, but their real estate recommendation is almost always publicly traded REITs, which suck, in my opinion, because they can be really volatile and it don't carry the same tax advantages that investing in a private REIT or actual direct ownership of real estate. Or they will say you can hedge with silver or gold, but put you into a gold stock versus gold bullion, each of which carries pros and cons, which I'm not going to get into the weeds on. So speaking now to savings account, in my opinion, they meet one need only, and that is for your emergency fund. Anything beyond 6 to 9 months of living expenses, in my opinion, is unnecessary and at risk of losing value. This is especially true with current interest rates being so low. You're literally getting next to nothing. I think I looked yesterday and the best money market rate on bank rate was 55 basis points or 0.55%. So with inflation nearly 10 times that, the purchasing power of your money and savings is absolutely getting crushed. Looking at CDs, I think most people know what CDs are. It's a short to medium term deposit in a financial institution that pays a fixed rate of return. CD rates right now for a 5-year term are around 1%. So if you want to just throw your money away, open a CD. But, hey, it is FDIC insured. So if that's important to you, then do that. Looking at stocks. So returns on stocks generally tend to beat inflation. Passive investors usually invest in stocks through a mutual fund or an ETF. Stocks, though, are more volatile during high inflation periods. If we look at the last 30 years, the S&P has averaged 10.7%, which outpaced inflation. The problem is that most investors are emotional and in and out of the stock market at the wrong times. So, for example, in 2008, many investors were selling out of their portfolios when the market was falling. So, and they were doing so from a perspective of fear and emotion. What they should have actually been doing is buying the dips. Now, this is obviously easier said than done. Stocks right now are at all-time highs, so it might be a great time to take some exposure off the table and consider other asset classes. The chart that we're looking at now shows that inflation creates volatility. I'm not going to spend a bunch of time here, get into the weeds on why, but I think it's important to note that inflation does create volatility in stocks. Looking at bonds, inflation is a bond's worst enemy. It erodes the purchasing power of a bond's future cash flows. So interest rates respond to inflation. So the Fed can raise its target rate to cool down an overheating or inflationary economy. The problem right now is that the Fed is trapped and it has to continue keeping interest rates low for a multitude of reasons. And like I said before, this is potentially a whole nother webinar in itself. Treasury inflated protected security, also called TIPS, provide a real rate of return guaranteed by the US government. So TIPS are another inflation busting product touted as the ultimate hedge against inflation. In reality, over the past 20 years, TIPS did in fact beat inflation handedly, but as it turns out, it didn't do much better than other fixed income assets like investment grade bonds. So what exactly is an inflation hedge? It's not the neatly landscaped bushes in your front yard. An inflation hedge involves investing in an asset that is expected to maintain or appreciate in an inflationary period. Hopefully, its appreciation exceeds or at least comparable to inflation. So let's talk about how and why real estate is an inflation hedge. There are three main reasons. Number one, real estate prices appreciate. Number two, income from rents grow with the consumer price index. And number three, depreciating debt occurs. So real estate has long been considered a hedge against inflation, as rent and property values tend to increase with inflation. So what we know is that most consumers buy homes based on mortgage payment, not home value. So with interest rates being so low, buyers can afford more home, and this drives real estate asset values up. We will continue to see appreciation with low interest rates, low housing inventory, and a booming demand. The latest edition of the Consumer Price Index indicated housing prices have risen 2.6% over the last year, while other reports suggest home prices are up more than 13%. S&P CoreLogic Case-Shiller Index shows annual home prices gains surged to 14.6% in April year over year. Phoenix led the way with a 22.3% year over year price increase. And I can personally attest to my home value going up 22% in 6 months, which is absolutely nuts. But with interest rates, demand, and lack of inventory, these are all factors that are contributing to prices going higher. So rental income growth is one of the best ways to hedge against inflation. As inflation increases, so does the amount a landlord can charge for rent, unless your assets happen to be in a rent-controlled district, like in Manhattan, for example. This ultimately keeps the landlord's income in pace with the rise in inflation. So this is great on a single-family property, but imagine the impact this can have if you own a 300-unit apartment building. Ends up in a pretty significant increase in the net operating income of that property. And the last main reason real estate can be a good hedge against inflation is that depreciating debt occurs, whereby the value of the real estate holder's mortgage payment depreciates. So, for example, a $100,000 mortgage payment during the first year of a mortgage will remain the same nominally, but may well only be worth $80,000 in the 10th year. All right, so happy to jump into any questions you guys may have right now.
Yeah, anybody's welcome to type it in the chat box, and we'll answer. What have you seen out there in Colorado, William?
Yeah, like I said, in my neighborhood, home values have gone up, you know, my house in particular in our neighborhood, 22%. You know, we're in kind of a unique market, a resort market that has seen a massive migration of, you know, people that had second and third homes here spending more time. And then additionally, people can't, you know, like the issue or one of the issues is there's a lack of supply. So, you know, I'd love to sell my house and make a ton of money. But then what am I going to do? Right? Like I can't live here. I'd have to move, you know, somewhere maybe less desirable, like Kentucky or something like that. No offense to Kentucky, but and then in the Denver metro area, it's absolutely bananas. My mom's a real estate agent, and you know she's having listings that, you know, getting 10 plus offers on the first day, mostly above ask, and usually the ones that are winning are all cash offers, well above ask. So
great, thanks. Do you see that question in the chat?
Let's see. Chat. Let me open that.
That's all right. I can read it.
Yeah. So can you please briefly discuss the impact of cap rate compression as a further boost to commercial real estate values? So I think what you're saying is because the cost of capital is so low and demand is high, that's pushing cap rates lower. So yeah, I mean, it pushes commercial apartment buildings pricing higher. That's certainly a factor there. And then there's also just a lot of people participating in that space. You know, the demand was strong before, and the demand is growing. I think a lot of people are realizing what a great space that's, what a nice asset it is. So there's a lot of people playing in that space now.
Yeah, likewise, I've seen the same. I didn't see any other questions come, so I want to thank you for joining us today, William. And you have your contact information and phone number up there, so feel free to reach out if you have any further questions. And if I can help you with any self-directed IRAs or retirement accounts, feel free to reach out to me. Again, Ryan Fisher, 215-283-2868. rfisher@camaplan.com is my email. Thanks for joining us, and have a great day. Thanks for the information, William.
Yeah, absolutely, Ryan. Great to be with you guys. Thanks for joining us, and we'll see you next time.
All righty.